It is my belief that a global financial reset is very likely to happen within our lifetimes, yet again, based off of 100 years of global financial reset history. So I want to be going over this in the most logical way possible. I do not want to be, promoting alarmism or anything like this. I think that this is a highly logical thread of analysis, and we're going to be going over what I have studied over the past 100 years that pertains to the changing financial systems, which essentially amounts to a reset and then something new emerging from that. Document what it's essentially meant for the average person, you and I, and then perhaps a solution to that. And then also at the very end of this presentation, I will be going over what I believe is likely to happen next. And I don't think it's even that far away, to be honest with you as well. Again, I really want to avoid any sort of alarmism here or anything like this. These are, very common things. They've happened many times within our lifetime. And then it even happens within the world leaders' sort of own words, as you can see right here. Mr. Schwab, Mr. Klaus Schwab, as everyone loves, he says it himself. And a lot of the time, this stuff is really above the board and actually is quite literally just out there. It's just no one's really paying attention, or at least, it's underneath a bunch of legal speak, or just hidden away from, I guess, the average person. Because, the average person is just, consumed with bread and circuses, as they like to say. So in his own words, the pandemic represents a rare but narrow window of opportunity to reflect, reimagine, and reset our world. And again, this is just, this has happened many times, and this is something that is just a part of our world. We can't expect anything to last for forever. Anyways, let's jump right into it, starting off with a definition of what a global financial systemic reset is. And a systemic reset isn't just a market crash or a currency devaluation. So I just want to differentiate this between this content on this particular presentation versus the last presentation that I had, which was more about, those sort of disastrous, overreaching situations. This is a completely different thing, although there will be some similarities and some similar situations as well that do qualify as both, actually. Anyways, what a global financial systemic reset is it's when the entire operating framework of the global monetary and credit system changes. The rules of how money, credit, and reserves function are rewritten. So this is really, 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 really important if you are an investor, or if you're just involved in the financial markets at all, which if you're on this channel, I imagine that you probably are. By the way, I'm going to continue to do more content like this because I genuinely love researching this sort of stuff. I'm a massive history nerd. So if you do want to get more content like this, consider subscribing, and we'll get on with it as it goes. Anyways, a global financial systemic reset occurs when the foundational mechanisms of the international monetary system are restructured, which changes what counts as money or reserves, who can create or access liquidity, and how value moves across borders. I believe with this definition set right here, we are absolutely going to see one of these happen. Okay, I shouldn't say absolutely, but extremely high probability, like greater than 98% probability. We're very likely going to see this happen. Maybe within the next few years. I would say certainly no more than 10 years, but probably within the next few years. We'll go over that situation and what that means at the very end of this video, and then also ways to protect against that, or just, what's likely to benefit most. And I also, before we get into the heart of this presentation and go through all of these case studies, I do want to say you don't necessarily need to watch this on YouTube. If you just want to listen to this and just hear my raspy lesbian voice kind of illustrate these cases over time, that's completely fine as well. There's not going to be any super important visual stuff on the screen here. Anyways, what are the general triggers for a financial reset? So again, I just want to lay the groundwork here a little bit more. There are several different categories, but here are the big ones that typically precede these sort of resets. The first one is going to be war or geopolitical shocks. So a description for this would be massive fiscal needs or trade realignments make old currency pegs or reserve systems unsustainable. You already know where I'm going with this one. We are certainly seeing this as of right now in this year of 2025. Debt saturation, probably also very relevant for this year, or in fact for many years. In the description here would be leverage and promises exceed real capacity to service them, meaning that a country takes on so much debt that it literally just can't pay it off anymore. The interest payments to effectively hold that debt and service that debt is what it's called. you can no longer make those payments. You just don't have the, the income coming in, which as government, they make their income, if you will, by taxes. So then the system requires devaluation or inflation to reset. We've also seen this, by the way, a couple times already in our lifetimes. Anyways, the next one would be monetary architecture failure. So this would be like your gold, your dollar pegs, or fixed rate systems can't handle flows, and thus convertibility suspensions or redesigns follow. So this, again, we've actually seen this throughout the history that we'll be going over. And then the last one would be technological or institutional breaks. This would be the creation of new institutions like the Fed in 1913 or the IMF in 1944, or new instruments like quantitative easing or CBDCs, which is something a little bit more relevant to the recent times, changes money creation itself. So these are the four basic categories that you will see preceding these events. They are big warning signals. They don't necessarily mean that the reset is happening at that exact moment, but it does set the backdrop for a reset. Anyways, I'll just do a very quick overview here of all the different events that we'll be going over. Again, I'm studying about the last 100 years, going back to 1907. And we're going to go through all these in detail. I just want to put this right at the outset right here so you just get a very quick overview of 11 very specific times that we've seen this in about the past 100 years. It does happen. It happens in some cases rather often, especially recently, as you can see. We saw the global financial crisis in 2008. Then we saw the pandemic liquidity crisis in 2020. And then we saw sanctions and the reserve seizure shock in 2022. And by the way, like I said, I do think that we're going to see another one probably before the end of this decade, maybe even, within these next few years. So as I take a sip of this water and prepare for our first event, let's get on with it. And I just want to repeat one of the slides actually from the past presentation as well. I just want to say, hey, this has happened countless times, about 11 times at least in the past 100 years for major world powers. And stories of financial systemic resets are numerous. In fact, it has happened many times already in our lifetimes, assuming that you've been around since at least, 2000. And that is not to discount the countless other times in recorded history, prior to the past 100 years. Just we don't have as great data on that, so I figure it's just not as relevant to you and I as of right now. It's just not as much information to kind of document. But if you feel scared while watching this or hearing this, it's because you should be. When shit hits the fan, don't expect anything different than what history has shown us over and over again. No one's coming to save you. No one's going to tell you, in advance. I mean, I'm going to try my best to do it, but I'm not going to be perfect with it either. But there is a solution, and we can use history as our guide to, one, understand what precedes these major events, which makes it, a reality, and then two, how to actually benefit most from it. And we're going to be tying in Bitcoin to a lot of this as well. All right, cool. Let's start it off with the Panic of 1907. This is going to lead to the creation of the Federal Reserve, by the way, in 1913. And yes, in case you didn't know, the Federal Reserve is a rather recent modern invention. Prior to 1913, the U.S. did not have the Federal Reserve. Anyways, what was the Panic of 1907? So here's the lead up. We'll go over the lead up, the reset, which effectively was the solution by the powers that be, and then what that meant for the average everyday person, meaning you and I, and then how you could have actually avoided that by using current technologies such as Bitcoin. Anyways, the lead up was this. The U.S. had no central bank and relied on private banks and trust companies to create credit prior to this event. A fragile reserve pyramid meant that when confidence slipped, liquidity evaporated nationwide. And excessive leverage in call loans, which were short-term stock market funding, and speculative trusts left the system vulnerable, naturally. And in October of 1907, October happens a lot for whatever reason, the failed United Copper corner triggered panic. The Knickerbocker Trust collapsed. Depositors across the country lined up to withdraw cash. And intrabank lending froze. So the call money rate spiked to 125% and payment systems broke down. So you can kind of understand just from this scenario that this issue did lead to a quite logical construction of the Federal Reserve. It effectively is a lender of last resort. And so in a situation like this, it would have helped, to be fair. It really would have. I know a lot of people like to talk shit about the Federal Reserve. Hey, there are some certainly a lot of drawbacks, but you can't deny that in many cases it does help. We would have significantly more financial pain without it actually than with it. That is my sort of very controversial opinion, especially on a Bitcoin related channel. But hey, like tell me how it would have been better to just let the whole system fucking collapse, because you're about to see. Anyways, the reset, or solution in this case, was JP Morgan and other financiers staged an emergency private bailout, essentially acting as an unofficial central bank. Policymakers realized the U.S. needed a formal lender of last resort and an elastic national currency. That is where the Federal Reserve Act of 1913 came in, which created a central bank that could rediscount loans and inject reserves into bank, issue Federal Reserve notes as nationwide currency, centralize gold reserves, and manage payment clearing. And of course, this reset the architecture of the U.S. money creation from a private market clearing system to a centrally managed one. Again, central planning, usually not good. But I am curious, if you aren't going to have something like this, what is the alternative? Just to let everything fail and just everyone's fucked? I don't know. Again, I don't have a better idea, but I can understand where this is coming from, is my point, before people start to get crazy in the comments. Anyways, here was the impact on the everyday average person. Again, you and I. So during the panic itself, over 240 banks failed, wiping out uninsured deposits, meaning your money's fucking gone, meaning you're holding money in the bank and it is no longer there. It's no longer yours, at least, and it has vanished as far as you're concerned. Families and small businesses lost their savings. Just, again, put yourself in these shoes. Like, I really want you, as I go over these situations, or at least what I like to do is I like to put myself in this situation and pretend that I'm experiencing this myself. Like, just imagine, like, you're looking at your bank balance account today, and then tomorrow, poof, it's gone. It's gone. Anyways, payrolls halted as employers couldn't access cash, naturally. Unemployment and bankruptcies spiked. So again, this just has, major ripple effects. Going to affect, the businesses now. So once businesses start to fail, then obviously it's not just the business failing, it's all the people that they employ failing, plus all the people that they, provide goods and services to, which no longer have access to that. And that just creates a massive, massive, massive rippling avalanche of despair, basically. In the long run, the new Fed system reduced the frequency of small bank runs, but it also entrenched the link between government and credit creation. This is where I can understand massive pushback to this. I totally agree. I totally get it. But hey, it does serve a purpose. That is for sure. Future crises would now be socialized rather than eliminated. Again, that's the trade-off. Is that better? I actually really don't know. I really don't know. The moral hazard born here set the stage for the ever-larging booms and busts as well. Anyways, Bitcoin parallel. So this is how, our modern technology in Bitcoin maybe could have actually helped in the situation. Obviously, with self-custody, Bitcoin, as a depositor, you wouldn't depend on a bank's solvency to access your savings. So if you actually put that money in Bitcoin, well, guess what? It's still there. Maybe, the price of Bitcoin versus dollar, maybe that would have crashed. Who knows? Maybe it would have gone up. Perhaps in the long term, it would have gone up. But in the moment it would have crashed. But still, at least you would have had something. Something would have been better than nothing, quite literally nothing. Of course, always on settlement, Bitcoin's networks moves value 24/7, so you're unaffected by these banking holidays or liquidity freezes. Of course, decentralization, no single financier or government decides who gets rescued. And there's a fixed supply. Of course, you already know this. Anyways, moving on from there, let's go to 1914 to 1925. So really just a few short years later, this was World War I. And in case you didn't know, during World War I, the U.S. actually suspended the gold standard. You can see it right here, on that newspaper. And this has actually happened multiple times, with Britain, with the U.S. later on. And it seems like, whenever it's convenient, this is what governments do. When push comes to shove, when they actually have to do it, they will make this, they will do this. They will make this trade-off. So I just want to draw a parallel right now with the situation that's going on in China, because China is recapitalizing their economy on gold, and I think Russia is as well. But China particularly, they are backing their currency with gold. gold. And that's going to be very, very attractive to other nations. But just like the Western nations, I would expect that if China does run into any real issues, what are they going to do? They're going to get rid of that gold standard. It's just the natural way of things. It happens every fucking time when push comes to shove. Because what are you going to do as a country? Are you going to let your country fucking fail? Or are you going to go down the fiat currency route? I mean, think about it. Do you really want to be the person in charge when the country fails? History is not going to remember that very, very politely. Anyways, the lead up to this situation was before 1914, the classical gold standard underpinned global trade. Currencies were freely convertible into gold and capital moved across borders with minimal friction. Of course, there is friction with gold after all, because, you have to transport it for one. And it's just, it isn't cumbersome, but up until this point, that was kind of like the gold standard, if you will. Anyways, this system required fiscal discipline. Very difficult for governments to do. Governments couldn't print money beyond their gold reserves. Again, when push comes to shove, what do you think a government is going to do when you are faced with an existential crisis? Are you going to stay on the gold standard because we're fiscally disciplined and we're going to do the right thing? Fuck no, man. They're not going to do that. Or at least they're not incentivized to do that. And typically incentives will drive these behaviors. Anyways, when World War I broke out, nations faced an unprecedented need to finance total war. Naturally, again, this is an existential situation. You're in World War I. This was the biggest war at the time. And, nations' livelihood were quite literally at risk. What are you going to do? Are you going to potentially lose your nation because you won't finance your wartime economy with fake money? Or, I mean, again, it's not necessarily fake, but you know what I mean, fiat currencies. Or are you going to stick to your discipline and be backed by gold, but, lose the fucking war? Two very bad choices, to be honest. Anyways, mobilization meant massive deficits and surging imports of weapons and food, while gold reserves drained abroad. To keep paying for the war, treasuries ordered central banks to suspend gold convertibility, turning every major belligerent's currency into paper. Within weeks of August 1914, gold outflows stopped everywhere except in the U.S., which is funny because, the U.S. is going to do this later, to be honest. But yeah, at least for now, they were playing it as one of the better or more, I guess, what's the word I'm looking for? Sophisticated nations, I suppose, or just responsible. Yes, responsible is what I'm looking for. Anyways, here was the reset or solution to the situation. Governments abandoned the gold standard and replaced it with managed fiat money for the duration of the war. Central banks monetized government debt, which is exactly what happens right now as well, printing currency to buy war bonds. So, I don't want this to really get blown over here. I want to repeat this sentence because it's really crazy when you think about it. Central banks monetized government debt, printing currency to buy war bonds. So the central bank would print money out of thin air and then go and buy war bonds for, their domiciled country. It's that crazy. It really is that crazy. It really is that crazy. They're printing currency to buy their own fucking loans, in a way. Anyways, price controls, rationing, and foreign exchange restrictions became normal economic tools. After the armistice, so after the war basically ended, countries tried to resolve pre-war parities, but most failed. It's very difficult to go back without significant amounts of pain. The United Kingdom, in 1925 attempt to do this caused severe deflation and unemployment, while others devalued permanently. So this is just like permanent. It's just permanent down. The temporary suspension effectively ended the classical gold system, replaced by a new norm of state-controlled money and capital flow management. Again, once these changes are made, it's just too difficult to go back without, a real reset. It just doesn't really happen. We don't really see that happen in history. Anyways, let's go over the impact on the everyday average person. So massive inflation naturally happened. Consumer prices quadrupled in Germany, tripled in France. Again, France in the UK, they were kind of the winners, I guess, in a way. But did they really win? I mean, they experienced a little bit less inflation, but whether it's quadruple like in Germany or whether it's triple in France or double in the UK, how many people could survive that right now? Almost no one. Almost no one who's a wage earner, at least. It'd be very difficult. Very fucking difficult. Imagine all of your expenses are doubled overnight or, God forbid, quadrupled. Anyways, fixed income savers and pensioners saw their purchasing power collapse. Again, so the people who are generally being more responsible with their finances, saving or buying, bonds or, basically just giving out loans, they are the ones who got fucked the hardest. Like, they were trying to be safe. They were doing what was the responsible thing. Boom, you just got wiped out. Sorry. We're not going to do anything for you, but we're sorry. That's basically the extent of it. Anyways, ordinary workers' wages lagged far behind prices. Food and fuel shortages were common. So it's not only that your purchasing power gets, like maybe cut into quarters, but also now you can't even just buy stuff. It's not even available. It's fucking hard to find. Capital controls meant people couldn't move their money or buy foreign goods. Financial isolation became the norm. Post-war, so after the war, when things are supposed to be better, right? Many currencies never regained pre-war value, and debt burdens triggered another round of crises. So things got really honestly worse, especially in Germany. Their hyperinflation in Germany in 1923 was the extreme, obviously. The world learned that governments, once unrestrained by gold, would always choose money creation over austerity in emergencies. Anyways, the Bitcoin parallel here. Well, immutable monetary policy. Of course, Bitcoin's issuance cannot be expanded for war finance or emergency spending. So you remove that political discretion from the money supply. I think that's probably a good thing overall. Borderless capital mobility. We already know this. Protection from debasement. Again, fixed supply shields long-term savers from wartime inflation. I think that's the big one right here. And then, of course, transparency. Anyone can audit the total supply in real time. There's no hidden liabilities or off-balance sheet printing for the Bitcoin holders. Anyways, moving on. Let's go to the next event. This was from 1931, the Sterling Crisis in the UK, which caused a global gold standard breakdown. Here's another direct newspaper headline from these years, from this time. I need to adjust myself in my seat, because otherwise I'll get hemorrhoids. I need to take a sip of this water as well. Okay, so the 1931 Sterling Crisis. So the lead up to this was after World War I, Britain tried to restore the pound's pre-war gold parity, which was about $4.86 per pound. In 1925, under Chancellor Winston Churchill, that is who was responsible at that time, the move severely overvalued the sterling, making British exports uncompetitive and forcing chronic trade deficits. Not fucking good. The policy required high interest rates to attract gold, which strangled domestic credit and kept unemployment above 10% for most of the 1920s. I want to remind you, unemployment above 10% is like catastrophic. Even above 5% is considered high. So that's literally double that. That's 100% more than 5%. And again, it was above 10%, so even more than that, I guess. This is catastrophic, like fucking catastrophic, to levels that you and I living in the Western world cannot even imagine. Global deflation from the 1929 Wall Street crash and the onset of the Great Depression caused gold reserves to drain rapidly from the Bank of England. By mid-1931, speculative attacks intensified, foreign investors withdrew funds, and Britain's gold reserves fell below safe thresholds. The failure of Austria's Credit Anstalt Bank in May of 1931 triggered the European contagion, further undermining confidence in the sterling. So this was all the lead up, just disaster after fucking disaster after fucking disaster. Anyways, the reset, the solution to all of this was on September 21st of 1931, Britain abandoned the gold standard again and allowed the pound to float freely for the first time in modern history. Uh-oh. So they're trying to do the right thing now, but you're about to find out what happens. What happened? The pound immediately fell about 25 to 30%. Just imagine, again, your purchasing power basically goes down by almost a third. And other countries followed as well. So there was a rippling effect. Scandinavian countries like Sweden, Norway, and I think it's Iceland is the other one. Japan, and eventually the US as well, all abandoned gold convertibility around 1933. The world transitioned into a managed currency era with exchange controls, competitive devaluations, and protectionist tariffs replacing fixed gold parity. Sounds real fucking familiar, doesn't it? This marked the final death of the interwar gold standard and a decisive shift towards discretionary central banking. And what was the impact on the everyday average person, you might be asking? Well, in the short term, British households saw import prices surge, making food, fuel, and basic goods more expensive. Savers and pensioners in sterling denominated bonds experienced steep real losses as the purchasing power of the pound drop. Again, if the purchasing power of the pound is dropping, if inflation is happening to such a degree where the inflation is outweighing the sort of return on that government bond, well, your real return is negative. You're losing money by loaning money to the government, basically, as your purchasing power is going down. Anyways, across Europe, nations that stayed on gold, like France and Switzerland, sank deeper into depression. So they got even more fucked. I know I'm laughing, but like it is not funny. It's like there's no reprieve, while devaluers like Britain and Japan recovered earlier. So what Britain did, actually, it was a better solution than the alternative for the everyday person, to be fair. Still wasn't great, but yeah, if you have to choose between shit and piss, I'm going to be choosing piss. Anyways, for the average person, the 1931 reset reshuffled wealth silently. Creditors and savers were punished, debtors and exporters gained. That's the key here. And financial repression became the norm. Here's your Bitcoin parallel. Sovereign store of value. Bitcoin's value isn't tied to any government parity or central bank reserve. Borderless liquidity. You already know this. No policy-driven debasement. Again, big one here as well. Neutral global pricing as well. Now, in all of these situations, I actually would have expected Bitcoin to lose significant amounts of value in the short term, but long term, we would have expected it to go up. In fact, I'll show you an example. This will hit a little bit more home once we get to this era here. But in 2020, what was this? This was March of 2020. This was of course, 2020 pandemic. And yeah, almost immediately it was a disaster. Bitcoin down about 50%. And of course, from there, it was a massive success, which led to even more issues down the road. But again, long term, that trend is very much your friend. Anyways, moving on. Let's go to the 1933 U.S. bank holiday, gold confiscation and dollar devaluation. Again, a nice little newspaper headline from this time. This is real shit. Anyways, the lead up to the 1933 U.S. bank holiday was this. The Great Depression had already destroyed confidence in the U.S. banking system. From 1929 to early 1933, over 9,000 banks failed. Are there even 9,000 banks around in the U.S. at this point? Wiping out deposits and triggering mass panic. Again, just imagine like your bank. Do you even know what it means for your bank to fail? I don't even really know, to be honest. Just your bank shuts down. I guess the Silvergate people from 2022 know, or 2023, I guess. But your bank ceases to exist. Where did your money go? I don't fucking know. The gold standard constrained the Federal Reserve from expanding the money supply. Gold reserves had to cover at least 40% of issued currency. Not happening. By early 1933, deflation gripped the economy. Prices had fallen 25%, kind of helping, I guess, but unemployment exceeded 25%. Deflation basically happens when you're just already so fucked to begin with. It's just really, it's a deflation of the standard of living. And people hoarded gold and cash outside banks. As gold flowed out of the country and the Fed's reserve ratio plunged, a nationwide bank run erupted in February to March of 1933. If you don't know what a bank run is, it's when people start to panic that the banks are insolvent, so they go and rush to get to the bank, and they want to pull out all the money that they can. And usually during this time, it's very difficult to get your money out because you're going to be waiting in a long line for banks. I mean, again, this is 1933. It's not like you just go on the fucking internet and say, withdraw. You have to actually go to the bank and be like, hey, sir, can I withdraw my money? And they're like, we don't have it. And you're probably also waiting in a long ass line as well, because everyone else is trying to do the same shit too. Anyways, entire states declared bank holidays, closing financial institutions to stop withdrawals. So again, when push comes to shove, they're just like, press the stop button. Like it reminds me of that meme where I think Ethereum was crashing and then Vitalik said something to the tune of like, okay, can you guys like stop trading now? It's basically that. It's really not much different, to be honest. It's really not much different. The humans are the same across time for at least for the last couple 100,000 years. So, I mean, that is the exact same sentiment. Yes, we've already said that. And when FDR took office on March 4th of 1933, the entire banking system was collapsing. He inherited like a really disastrous situation, honestly. Anyways, the reset that followed this, so the solution from the government was on March 6th of 1933, FDR declared a national bank holiday, closing every bank in the U.S. for 1 week. Again, what are you gonna do if you don't have any money for a fucking week? Like, oh God. This was before, obviously, credit cards too, or even, debit cards for that matter. Like, if you didn't already have a bunch of paper cash or just gold sitting, underneath your mattress, you had no access to money for a week. You and I can, again, in the Western world, cannot even imagine this at this point. Anyways, the Emergency Banking Act of March 9th of that year, 1933, gave the Treasury sweeping powers to control banking operations and restrict gold transactions. Then, about a month later, on April 5th, Executive Order 6102. Many Bitcoiners already know this. This required all Americans to surrender their gold coins, bullion, and certificates to the Federal Reserve in exchange for paper dollars. Hoarding gold became a federal crime. So I just want to highlight this for a moment here. Again, I know many people are very familiar with this, but at this point, the U.S. dollar was still backed by gold, and it still was. But you were basically forced to give up your gold, and the government just gave you paper certificates in return. These paper certificates were supposed to basically give you, an equal amount of gold for whatever the conversion rate was, basically. So that was the sort of deal. But immediately after the government forced you to give away your gold and receive those paper, IOUs, basically, what they did was they repriced gold in 1934. So, about a year later, not that long after, the Gold Reserve Act in 1934 revalued gold. So they just straight up said, okay, your gold is no longer worth $20.67, which is what the price was when they forced everyone to turn it in to the Federal Reserve. And instead they said, all right, now gold is worth $35 an ounce. So what that did is it just devalued the US dollar by 41%. Again, the dollar was related to gold. Gold's price just went up, and the dollars that received the year prior to that, now they're basically losing about 41% of their purchasing power. That's a real big fuck you. Now, again, I don't really know what the alternative to the situation would be. So I don't want to personally make like the big mistake in my eyes of just blindly condemning this action, because these situations are very, very complicated. I'm not sure that an alternative would have been better, but this was, there is absolutely no denying this. This was a big fuck you to everyone who actually did what the government wanted. And again, I'll remind you, this was a very popular decision by the Americans. So not just the government, but the American people were in favor of this. At that point, we were very nationalistic in a way, and we wanted to support the country. We want to support the country, or the Americans did. So the reset ended domestic gold convertibility, centralized gold in the hands of the U.S. government, and expanded monetary control, ushering in the modern fiat era in America. Again, and also devalued your fucking dollars by 41% in the process of it. So that is intense. That is very intense. Anyways, the impact on the everyday person: immediate shock, of course. Citizens no longer had access to their bank deposits for a week. I mean, that's bad enough, honestly. Confiscation effect: anyone holding gold lost purchasing power when forced to trade it for paper dollars, and then watched gold's price rise 69% under government control. It's like, oh, that is so painful, so fucking painful. Savers in cash or fixed income assets saw the real value of their holdings erode by over 40% overnight after the revaluation. Again, I want to really fucking hammer this in. During financial resets, the savers and bondholders, the fixed income assets, basically, they are the ones who get really fucked hardcore. Okay. So if you think that a financial reset is coming, that is not the best thing to be fucking holding. I'll tell you that straight up. The psychological shift was enormous. Americans learned that their money could be redefined by decree, and that ownership of sound money, gold at this time, was now illegal. Businesses and farmers with debts actually benefited. So people with debts, so the people who are not responsible, they benefit. Dollar devaluation reduced real liability. So again, if you owe someone $10 and then the government reprices gold, which effectively devalues the currency by, let's just say 50%, and you still owe that person $10, but that's just, it's just worth a lot less now. It's a lot easier to get that $10 because, basically it's basically half that. So yeah, anyways, the depression lingered, but the financial system became permanently state managed. Currency value and liquidity were now political tools. And I just want to say, at this moment, if not for anything else, this is absolute evidence that America is certainly not like as capitalistic as many people make it out to be. There are many elements of socialism in America. And again, I understand that some of it probably is necessary, but there is certainly a line where it does become very fucking bad. Absolutely. Anyways, the Bitcoin parallel here. Of course, if you're holding Bitcoin, you could avoid confiscation by executive order if you hold your own private keys. Could you still be called a criminal? Yeah. But that would make that whole thing a lot more difficult, I imagine. Monetary independence. Of course, its supply cannot be expanded or devalued by government decree. Beautiful. You don't have to worry so much about inflation in that regard, devaluing your Bitcoins. 24/7 access, no bank holiday can freeze your ability to transact or move funds globally. And again, transparency. Unlike the opaque 1933 gold revaluation. Anyways, moving on, we have a big one here. This is a fucking big one. This is 1944, the Bretton Woods system and the creation of the U.S. gold order. All right, let's jump into this one. And this is like an actual picture from that event, by the way, as well. Anyways, here was the lead up to Bretton Woods. By the end of World War II, the global monetary order lay in ruins. The pre-war gold exchange standard had collapsed in the 1930s. We already went through several instances of that. European currencies were broken by wartime inflation and debt. Global trade and capital flows had virtually stopped. And the U.S. emerged as the only major creditor nation, holding about 70% of the world's gold reserves, which was at the time about 20,000 metric tons of gold, which is crazy, and accounted for roughly half of the global industrial output. So the U.S. was really the winner of World War II, even though the U.S. technically did. I mean, the U.S. certainly contributed to the winning of World War II, but if we actually were very honest about it, other countries certainly sacrificed a lot more, let's say. But in terms of who actually won at the end of the day, it was by and far away the U.S. Coming out on top. Anyways, with the old system gone and the U.S. the new financial anchor, a new framework for global stability and reconstruction was needed. This led to the reset. So here's what happened. So basically, the U.S. won World War II and then dictated the terms of how the global financial order would work after that. And again, I don't want to casually denigrate this decision here, because what is the alternative? Well, what typically happens in history when you have one nation that wins a big war? They subjugate all of the other nations in like a very, very stringent militaristic way, basically imposing their will on them, like by taking over their governments and shit like that. The U.S. did do that, but instead of just replacing other people's governments, they just said, hey, look, you're going to use our system. This is how it's going to work. And if you don't like it, speak to my fucking nukes. I mean, basically, that was it. So yeah, I could definitely argue that this would be preferable to like the U.S. just installing, or just forcing all the other countries to like basically become the U.S. or a part of the U.S. Like the U.S. have literally taken them over. Instead of that, it's like, hey, you can still have your own system. You just have to use our financial system. Probably preferable, to be honest. Anyways, the reset. So the solution here was in July of 1944, 44 allied nations gathered in Bretton Woods, New Hampshire, to design a post-war monetary order. So all of the other nations were technically involved in this. I don't know how much input they really had, to be honest, but yeah. The agreement created this. The International Monetary Fund, so the IMF, was created on the back of this to oversee exchange rates and lend to countries in temporary deficit. The World Bank was created to fund reconstruction and development, and a new system of fixed exchange rates was created. So the US dollar was convertible into gold at $35 an ounce, and all of the currencies were pegged to the US dollar within a 1% plus or minus band. So basically, everyone had to recapitalize on the US dollar in a way. which is very beneficial to the U.S. Basically, you have a bunch of people who have to buy your fucking bonds, which is really, really good, which also creates a vulnerability as well, because if the other nations stop buying your bonds, well, as we're experiencing right now in the U.S., it's much more difficult to finance your debt, to finance your debts. And the U.S. is taking on significant amounts of debts to the point where if things continue, it's not going to be able to service those interest payments. It becomes a Ponzi scheme in a way. Anyways, capital controls were accepted as normal to prevent destabilizing flows. Effectively, the world entered a gold-backed dollar standard, where gold reserves were held in dollars, not directly in gold. The system officially launched in 1946, institutionalizing the U.S. dominance in global finance. And here was the impact on you and I, the everyday person. For the next 2 decades, the Bretton Woods system brought relative monetary stability. It's actually pretty good. For the average person, this is generally thought of like the golden years, especially in America, from the 50s to the 70s. 70s on, not so much, or especially the 70s, but after that, kind of good again, I guess. Anyways, trade expanded and inflation stayed low. And that's the thing, with this sort of system, it can work if you just don't have any external disastrous financial situation, which requires, more inflation. Naturally, that is going to happen, though. Just like a black swan, it might be low probability, but it is guaranteed to happen given enough time. So the system inherently is fragile and will break given enough time. That is a certainty, unfortunately. Anyways, this stability came at a cost to personal financial freedom. Capital controls restricted citizens from moving money or investing abroad. This is in the U.S., by the way. Interest rate caps and financial repression meant savers earned artificially low returns while governments inflated away wartime debt. Not fucking good. Dollar privileges. Americans could buy foreign assets with freshly issued dollars while other countries had to earn or borrow them. So this was massively beneficial to Americans. Basically, America, as the world reserve currency, could print its own currency at will. And then the Americans could borrow that and then go buy foreign assets with these freshly issued dollars. And of course, the other countries are getting inflated away, and they can't just print that money anyways. They have to actually earn it and then perhaps buy some assets. So for ordinary citizens in Europe and Asia, rebuilding economies meant decades of austerity and limited access to global markets. Wealth creation was centralized through government planning and the banking elite. And we can see now, in Europe and lesser extent in Asia, although they did deal with it for a little bit, but I think in like the past 30, 40 years, many of the Asian countries actually kind of flipped around. But Europe especially, you can see the quality of life there is just nowhere near. They they were kind of forced into austerity instead of just trying to grow their way out of things. And unfortunately, what happened? Government became very, very powerful. Banking elite became very, very powerful, and those entities have benefited significantly. But the everyday person, not so much, unfortunately. I know people like to romanticize Europe and everything. Look, I've lived in Europe for many years. I can tell you straight up, and I've lived in some of what are considered like the best and nicest countries with the highest living standards in Europe. I can assure you, the average American lives significantly better than the average European. Despite what you hear, again, you're hearing it from someone who has lived in both places for many years at a time. I mean, obviously in the US, I've lived there for decades, but in Europe, yeah, I've lived there almost a decade, like a long time. Anyways, as we move on, Bretton Woods quietly shifted global wealth towards the U.S., whose currency became the world's ultimate collateral. So here's your Bitcoin parallel here. Sovereign independence. Of course, Bitcoin allows individuals and nations to hold reserves not tied to U.S. policy or dollar liquidity. In this particular instance, it would be people outside of the U.S. are better benefited by holding Bitcoin. It would have benefited basically Europe in many ways, which is very bizarre because Europe seems to be so hostile to Bitcoin right now, or crypto in general. Anyways, borderless convertibility, you already know this. Hard cap versus soft peg, you already know this as well. And the decentralized reserve asset, of course, nations or individuals could hold Bitcoin as digital gold, which is immune to reserve manipulation that later broke Bretton Woods. Okay, moving on. We got the Nixon shock in 1971, the end of gold convertibility. So if we recall from the prior financial system, you could convert your dollars into gold. That was the promise of Bretton Woods. About 25 to 30 years later in 1971, the US broke this promise. This was, in my opinion, very bad. Very, very bad. Anyways, again, a nice little newspaper headline here for you. Nixon freezes wages and prices. Great. Anyways, here's a lead up to the Nixon shock. The Bretton Woods system that we just went over depended on the US dollar being redeemable for gold at $35 per ounce. But by late 1960s, America's fiscal discipline had completely broken down. Why? Because America had multiple wars. It had the Vietnam War, had also the Korea War as well. So spending a lot of money for these. Also, the Great Society program produced massive budget deficits. So, one of the really the biggest evil is just living beyond your means. Honestly, God, I don't understand why there are people who will argue otherwise. Look, don't live above your fucking means. I'm telling you right now, if you want the biggest financial unlock, and if you're not already doing it, just don't live above your fucking means. It's really that simple. Don't live above your means. Use whatever excess cash you generate as income to buy assets. If you can do that, you're going to do generally okay, at least, and in some cases, extremely well. Anyways, U.S. inflation was rising sharply around the beginning of 1970s, and CPI was up to about 5 to 6% annually. Again, I want to remind you that as of the past 20 years, generally CPI is targeted to be around 2%, and that's considered normal and good. So 5 to 6%, which is 2.5 to 3 times that amount, is overwhelmingly more nasty. That is considered very, very high. Anyways, foreign governments accumulated vast dollar reserves. More dollars existed abroad than the U.S. had gold to back them. So basically, the U.S. lent out so many fucking dollars to the rest of the world that we no longer had the gold to actually support those loans. Anyways, France, under Charles de Gaulle, openly called the U.S. a creditor of last resort, which is kind of funny, and began converting its dollar reserves into gold, physically shipping bullion from Fort Knox, which is in the U.S., to Paris. By mid-1971, the U.S. gold stock fell below 9,000 metric tons, which was insufficient to cover foreign claims. So basically, if all of the people that the U.S. lent to wanted to recall and basically exchange their dollars for gold, the U.S. would not have enough gold to actually give them that gold that they are technically owed. So again, the U.S. made this promise during Bretton Woods, and then basically by the 1970s, we broke it. Why did we break it? Because we overspent. We overspent budget deficits, and again, these were probably well-intentioned things. I mean, maybe not so much the Vietnam War, but the Great Society program, probably well-intentioned, but you borrow too much and introduce these, big government programs. It's just not based in fucking reality, and it creates a real issue later on. And this is a real fucking issue here. Of course, after this happened, global confidence in the dollar's gold convertibility was collapsing because people realized, oh shit, they don't even have enough gold to give us. So foreign central banks were lining up to drain U.S. gold reserves, basically a bank run on the U.S. And the solution, the reset basically from the U.S. was on August 15th of 1971, President Richard Nixon announced an emergency program that shocked the world. What he announced was the U.S. was going to suspend dollar convertibility into gold. Do not gloss over this statement lightly. One does not avoid this statement lightly. Again, the U.S., after Bretton Woods in the 1940s, which promised you can borrow all the dollars you want, we will back that with gold and you can redeem it for gold. We said, actually, we're not going to allow you to convert your dollars into gold. And that ended Bretton Woods basically on the spot. It imposed a 90-day wage and price freeze to combat inflation. Maybe not the best idea, but again, I understand. Added a 10% import surcharge to protect U.S. industries. So, basically tariffs in a way. And again, a 90-day wage and price freeze. Plus, you can't actually get gold from your dollars anymore. We're not doing that anymore, I guess. Anyways, the unilateral move abandoned the global gold standard and severed the financial link between money and tangible reserves. Within 2 years, all major currencies began to float freely. Basically, they just weren't pegged to anything is what that means, creating the modern fiat money era. The dollar remained the world's reserve currency, but not by gold backing. It was now by military and economic dominance. So basically, The dollar was no longer backed by gold. It was backed by, I don't know, like 5,000 nukes or however many we have. And if you don't like it, then hey, we're gonna whip you into shape. And then central banks now operated under a new paradigm. Money creation became purely a policy choice, unconstrained by reserves. And we are currently living in that still. Anyways, 1971 Nixon shock. Again, what was the impact on your everyday average person, you and I? The decade that followed. So throughout the 1970s, it was brutal for savers and the working class. Again, savers get fucked. Savers get fucked. You save your money, you get fucked. You save in dollars, you get fucked. You're in the working class, you get fucked. No, it's not necessarily you have to be in the working class. It's just people who save dollars get fucked. If you buy assets, you get to do some fucking. But yeah, if you're saving in dollars, if you're holding dollars, you get fucked. Inflation exploded. U.S. CPI hit 13.5% in 1980, erasing purchasing power. It really only takes a few years of basically 13.5 or even just more than 10% of inflation to have your purchasing power. Again, that means you have $100 last year, and then this year it can only buy $50 worth of stuff. Sucks. Or basically you need $200 to buy that same $100 from the year prior. That's kind of what I meant to mean. Anyways, mortgage rates soared above 15%. Again, people are crying right now because there's 6% mortgage rates. This was more than double. Bondholders and cash savers were destroyed in real terms. Yeah, just terrible. Like, Jesus Christ, man. The 1970s became the great inflation decade. Wages lagged behind prices, and the middle class began losing ground. And this is also a big feature of this as well. Look, if there's one thing if I could just wave my wand and hope to make things better with just one change or just one heuristic, I would say prioritize the middle class, make the middle class robust as fuck, because that is the backbone of any successful society, or financial society, I should say. It is the middle class, absolutely. Anyways, gold and hard assets skyrocketed as investors fled paper money. Gold rose more than 2,300% from 1971 to 1980. We'll go to the chart right now. Okay, 1970 to 1980. Let's see exactly what that looked like. Hopefully this chart has it. Let's see. Does it go back far enough? It does. Okay, beautiful. So from 1970 it was down around here at about $35 an ounce, exactly as we were speaking about before. From there until 1980, it went up all the way to almost $1,000. That's fucking crazy, man. And then from 1980 to basically the early 2000s, it was more or less flat and sideways. Anyways, back to our presentation. Okay. Yes. Okay, where was I? Yeah, the rules of money had changed forever. From here on, debt creation and inflation would become permanent features of the economy. If you are an investor in today's world, you absolutely must understand this absolute fact. Debt creation and inflation are permanent features of the economy. It is supposed to inflate. Debt creation is what allows this to continue on. And again, when inflation is relatively low at 2%, it's actually really fucking good. It's actually really good. The problem is that there's always going to be some sort of vulnerability when you're on a system like this, because at some point you will run into one of these black swans like we had in 2020, for example, which completely fucked this equation up. And once you fuck it up once, it's just going to get more fucked up later. Like it becomes more and more vulnerable later on. It's a really unfortunate reality and one of the worst realizations I've come to myself. Anyways, ordinary citizens didn't vote for this reset. It was announced on live television over a Sunday evening, changing the global monetary system while people were eating dinner. Again, you're eating dinner, you're listening to the radio or your like black and white television, and you get told, "Hello, sirs and sirs, your gold is no longer your gold. In fact, your paper dollars cannot be redeemed for gold any longer. They are just paper dollars, and we can issue them at will. So enjoy. Have a nice dinner, fuckface." Anyways, the Bitcoin parallel here, you already know where I'm going with this one. Immutable monetary base. Again, you got that 21 million cap with Bitcoin. can't be changed. Trustless standard. Its value is enforceable by code and consensus, not by political promises or convertibility issues. Illusions. It's like, who would I want to trust? A person or a literal mathematical equation? Well, probably most people are going to choose the mathematical equation. Maybe not everyone, though. Anyways, protection from fiat dilution and decentralized reserve. Again, Bitcoin functions as a modern digital gold, but one that cannot be confiscated or demonetized by a government. Big, especially on the point of confiscation, because we know that that can and does happen, historically speaking. All right. Now we got the next one. Oh, baby. 1979 to 1982. So just a decade later, basically. These happen almost every 10 years, it seems like. We have the Vulkar shock, which was the re-anchoring of money. All right. So what was the lead up to the Vulkar shock? So during the 1970s, as we just went over, the great inflation was the direct consequence of the Nixon shock. Actually, sorry, before we go into this, I do want to just quickly show you what U.S. markets like the SPX looked like during the 1970s, because you need to know how bad this actually was. Can we get on this chart? Yes, we can. All right, beautiful. Yeah, so here's the 70s. You can tell because the chart was basically flat. So throughout this whole period right here, you will notice that instead of just going up, the economy was sideways as fuck for about 10 years. Well, actually maybe a little bit more than that, from about the late 60s to the early 80s. The economy was flat. It was sideways. You weren't experiencing any real growth because inflation was running rampant. And we did have another period like this over here as well, to be fair. But yeah, these are very, very nasty times. Anyways, back into the presentation. So, so during the Nixon shock, again, great inflation happened, and the transition to a pure fiat system caused these things. Oil embargoes in 1973 and 1979 drove energy prices up nearly 400%. So again, your gas basically goes up 400%. So the oil, the lifeblood of productivity rose 400%. That's going to make things really difficult. Governments responded with expansionary fiscal policy, not austerity, which actually, in my opinion, is the right thing to do. Because again, just look at Europe. They choose austerity and it ain't so great. And then of course, the money supply, M2, grew over 12% per year. Inflation became structural, not cyclical. It just became a feature, not a bug. It's just, this is what it's going to be. We do have inflation. We know we have inflation. We want inflation. It's again a portion of our economy. It's actually needed for the economy in this current structure. Anyways, by 1979, the US CPI inflation hit 13.3%. Long-term treasury yields exceeded 10%, and real interest rates turned negative for nearly a decade. Again, savers aren't just fucked for like a few days. They're fucked for almost 10 years. It gets this is bad. This is really fucking bad. Again, you have to put yourself in this situation. Like, you have to pretend as if this was you, because guess what? It is going to be you at some point. In fact, maybe even right now. I mean, shit, man. It's not like fucking bond yields are great right now anyways. The dollar was collapsing against foreign currencies. Gold had surged from $35 an ounce in 1971 to $850 an ounce in 1980. We already looked at the chart for that. Confidence in Federal Reserve evaporated, and markets believed politicians had lost control of money. So again, the belief in when you have a fiat currency, belief is a really, really strong component. You need the people to believe. So when this happened, it is disastrous. So the reset, the solution here was in August of 1979, President Jimmy Carter appointed Paul Volcker as Federal Reserve Chairman with a single mandate: crush inflation at any cost. On October 6th of 1979, Volcker announced a new policy framework. The Fed would target the growth of money supply, which is M1, instead of interest rates. Interest rates would float as high as needed to choke off inflation. Basically, the Federal Reserve would raise the interest rates until inflation came down. And they raised it real fucking fast. Again, I want to remind you that in our current era, in 2022, when the Fed was raising interest rates, they raised it from basically near zero to about 6%, somewhere around there. In 1979, Volcker raised the federal funds rate to 20%, more than 3 times what we just dealt with. That's how fucking crazy things got and actually what was needed to tame this issue. The prime lending rate hit 21.5%. Fucking insane, man. The Fed engineered a deliberate recession to reset the price of money and restore credibility. So basically, the Fed had to reset the economy because inflation was too crazy. And this was, well, the most direct way of doing that. Was this the right thing to do? Probably. Again, would there be an alternative? Yes. Would the alternative have been more painful? Probably, yeah. Anyways, this became known as the Vulkar shock, the moment the modern regime of central bank dominance and disinflationary credibility was born. Anyways, the impact on everyday people, the medicine was brutal. So basically, the medicine meaning what Vulkar did, raising the interest rates, or the federal fund rates, I should say. The medicine was brutal. Unemployment hit 10.8% in 1982. Again, I want to remind you, anything above 5% is considered really fucking high. The highest since the Great Depression, by the way. Mortgage rates above 15% wiped out housing affordability. Foreclosures surged. Not fucking good, man. Again, that is like disastrous rates. Small farms and manufacturers failed en masse. The Rust Belt era began. Bondholders finally saw real positive returns, but only because millions lost jobs. Yeah. For ordinary people, it felt like a financial purge. Wages stagnated, debts became unbearable, and credit dried up. But the reset worked. Inflation collapsed from 13% to below 4% by 1983. It took a couple years. You know, it was really fucking ugly for a couple years. It did get better, but again, all of the pain that was caused in the prior years, that's still there. That's still there, you know. It's irreparable damage. The 1980s ushered in a 40-year era of falling rates, rising asset prices, and the myth that central banks could indefinitely control economic cycles. That's kind of where we're at right now, by the way. Vulkar restored faith in the dollar, but at the cost of a generation's livelihood. Basically, and again, maybe that was necessary, and maybe that actually was the right thing to do. I mean, you know, why did things inflate to begin with? Well, taking on too much debt, spending money that you don't fucking have. Like, as soon as you start doing that, you are going to run into issues. I cannot stress this enough. It seems like such a fundamental thing that I feel like everyone should be screaming at the top of their fucking lungs that, oh my God, get the damn deficit down. Get it down as fast as possible. Use every realistic measure to do it, please. Because when things fall apart, it's going to be significantly more painful. Anyways, Bitcoin parallel here, monetary sovereignty, you already know this. Programmable discipline, you already know this. Hedge against central bank error, you already know this. Global neutrality, you already know this as well. Unlike the dollar-centric system rebuilt under Vulkar, Bitcoin's value-based isn't tied to any nation's debt markets or political agenda. Anyways, now we move on to Russia. So this is going to be in 1998, Russia default and LTCM contagion. All right, here's the lead up to the Russia default of 1998. In the 1990s, this was the period of like this was the decade of globalization and leverage. Emerging markets liberalized rapidly after the fall of the Soviet Union. So emerging markets in this case really just means, like second world nations, I guess. So like the Soviet bloc, the former USSR, these sort of places were considered emerging and they were liberalizing, which we think of as good. But I'll explain why later on. There were some, in my opinion, major mistakes made. Now, again, I'm just some random fucking derp from the internet. I don't have full information on this. I probably am wrong anyways, but I will give you my opinion on it regardless. Anyways, Western hedge funds and banks poured in capital to these emerging markets, seeking high yields on short-term government debt. Russia, which was newly capitalist at the time but fiscally unstable, issued vast amounts of short-term ruble-denominated treasury bills, which were called GKOs, to finance its deficit. So basically they said, hey, you loan us money, we'll pay you back later through these GKOs, and we'll give you a high interest rate on that. And it'll be short-term duration as well. So that's quite attractive to a lot of hedge funds. By 1998, crude oil had collapsed below $11 per barrel, strangling Russia's export revenue. In case you didn't know, Russia's main export is oil. It's one of the reasons why they are incredibly rich, or at least have a bunch of riches. It's due to their access to natural oil. Tax collection, however, in Russia was very weak. Debt services, the cost for their debt, so the interest payments on their debt, skyrocketed, and confidence evaporated. from the financiers and also the people as well. Simultaneously, the 1997 Asian financial crisis had already triggered a global flight to safety. Capital was rushing out of emerging markets. And by mid-1998, Russia reserves were nearly depleted, and the ruble peg was unsustainable. Western financial institutions, especially hedge funds, were massively leveraged on the assumption that global central banks would never let a sovereign default ripple across a system. Does this sound familiar? Anyways, here was the reset that happened in Russia. So on August 17th, 1998, Russia announced a triple shock. They were going to devalue their ruble, so that's their national currency. The peg to the dollar was abandoned at this time, and a default on that domestic debt, so those GKOs, was announced, and that was worth about 40 billion, by the way, which was a lot to them, of course, and a 90-day moratorium on payments to foreign creditors. So basically, they said we're not going to pay you for 90 days. Anyways, the Russian financial system collapsed overnight, like literally fucking overnight. Banks shut their doors, ATMs ran dry, and imports disappeared. The default set off a global chain reaction. The most spectacular casualty was long-term capital management. A hedge fund run by Nobel laureates leveraged 100 to 1 on convergence trades. So basically, they were trying to take advantage of this. And because Russia basically said, fuck you, we're not paying, they went bust overnight, which is not good. Anyways, this caused a contagion effect. So LTCM, long-term capital management, that firm, their losses threatened to topple major counterparties. So the other people were taking the other side of their trades as well, like Merrill Lynch, UBS, JP Morgan, other financial system players. So you can see how fucking up one can lead to a major ripple effect into the rest of them. And in September of 1998, the Federal Reserve organized a private bailout, compelling 14 Wall Street banks to inject $3.6 billion to stabilize LTCM. This was the prototype for the 2008 crisis response, by the way, in case you didn't know. Coordinated bailouts of private institutions deemed too interconnected to fail. Doesn't that sound familiar? A new era began where financial risk would be socialized, but profits privatized. Yeah. That's kind of where we're at now, still. Anyways, what was the impact on the people? Well, in Russia, the ruble lost 70% of its value within months, so inflation surged over 80%, so people got fucked. Imported goods, including medicine and food, vanished. Couldn't work anymore. Savings were wiped out. As always, savers get fucked. Savers get fucked. That's one of the most common threads here. Savers get fucked. You're a saver, get fucked. Middle-class families saw their purchasing power collapse. Monthly salaries often covered just a week's expenses. Again, monthly salaries just covered a week's of expenses because the currency inflated so fucking quickly. And again, you need a robust middle class. For any successful nation that wants longevity, you need to prioritize the middle class. It's just a fact. It's just a fucking fact. Globally, market panic spread. U.S. Treasury yields plunged below 4% as investors fled to safety. The Fed cut rates 3 times in 6 weeks. So again, if you've been paying attention to the Fed recently for the past few years, you've probably noticed that they make interest rate decisions every month or so. Not technically not every month, but about every month, let's say. In this case, they did it 3 times in 6 weeks. So in just around about a month and a half, they did it 3 times. That shows you how desperate things were getting. And the president was clear. The president, I should say, not the president, but the president was clear. Whenever over-leveraged finance broke, central banks would step in to cushion the fallout. Ordinary people endured inflation, unemployment, and the hollowing out of their savings. Beautiful. We love just killing ordinary people, right? Of course not. I mean, this is disastrous. While those nearest to the money spigot, like banks and the funds, survived and thrived. Again, people who saved, you get fucked. Bitcoin parallel here, decentralization risk, you already know this. Transparent system, you already know this. Personal custody, you already know this. Non-correlated asset, you already know this, but it is kind of correlated as well, in my opinion. But technically not. Anyways, no moral hazard. Bitcoin's rules can't be rewritten to rescue the reckless. It's financial Darwinism by design. Anyways, that leads us to the next big one. 2008 to 2009, the global financial crisis, the GFC, which led to QE and ZIRP. It rhymes as well. Didn't even realize that at first. Anyways, here's a lead up to the GFC. By the mid-2000s, the global economy was a leverage machine built on the illusion of stability. Decades of falling interest rates since the Vulkar era encouraged borrowing at every level. Households, so your everyday person, corporations, and governments, all borrowing as much as they possibly can get their hands on. The U.S. housing bubble was fueled by subprime mortgages, securitized into complex derivatives. So basically what happened is people were taking on mortgages. And to be honest, I want to be super clear on this. I actually, I blame both sides of the equation on this one. Absolutely. There were banks giving mortgages to people who the banks knew the people taking those mortgages couldn't pay them. The people taking those mortgages knew that they couldn't pay it, and they would take it anyways. So it takes two to tango, in my opinion. Anyways, what would then happen is the bank knew, okay, well, this person probably can't pay back this loan, but that's fine. I can just pack this into another product, to another security basically, and sell this to someone else. And because we'll mix it up with some other, somewhat good stuff, high quality debt, we will rate this AAA, meaning that it is actually good investment grade sort of quality. And this is where I think the real criminals of this one should have been or should be identified, which was the agencies who made these AAA ratings on those securities. And then they would sell it off to someone else. So they basically didn't need to deal with the consequences. This is quite literally the concept of skin in the game at work. The lenders didn't have to actually count on those people who they gave loans to paying them back. They just would sell that to someone else who could collect on it later, and they probably were selling it again to someone else, to be honest. Anyways, banks operated with tangible leverage ratios above 30 to 1. Hiding risk in off-balance sheets, vehicles, or called SIVs. Credit default swaps created trillions in synthetic exposure, effectively infinite leverage on finite collateral. Again, where do all these issues come from? Borrowing money that you don't have. It all comes back to almost the exact same fucking thing every goddamn time. Don't live above your means. Don't live above your means. Holy shit, don't live above your fucking means. Anyways, global imbalances worsened. The U.S. consumed on credit while China recycled trade surpluses into treasuries, keeping rates artificially low. So basically, China was buying the U.S. bonds, which kept those numbers down. So again, it's just going to create some pretty nasty contagion here. Anyways, when housing prices began to fall in 2006 and 2007, the collateral pyramid cracked. Bear Stearns hedge fund failed in July of 2007. Northern Rock Bank had a bank run this was in the UK. This was September in 2007. By September of 2008, the entire system was imploding under counterparty distrust. No one knew who was solvent. And Lehman Brothers, of course, famously collapsed on September 15th of 2008, freezing global interbank lending and derivative markets. The world had entered the first true systemic credit freeze since 1929. Again, we repeat the same fucking things over and over again. It's crazy. It's absolutely crazy. Despite all of the overwhelming evidence out there in the world, we make the same mistakes over and over again. It is mind-blowing. It's truly unbelievable in my opinion. Anyways, need to adjust my seat again. Hemorrhoids popping up. Just want to highlight one of these statements. Which one was it again? Yes, okay. Actually, no, we can move on. Yes, okay, let's move on here. The reset. So here's the fun part. Here was a solution. Governments and central banks launched an unprecedented coordinated rescue. So basically, all of the major nations got together, the central banks got together and agreed on this. They were going to inject capital into major banks. So by the way, in the US, this was 250 billion TARP funds, the old TARP funds. Everyone loves that. Full guarantees on deposits and money market funds. So basically the government, the central banks came in and said, hey, if you have your money in money markets, which is short-term government debt more or less, you will have full guarantees on that. And we will also fully guarantee your deposits in your bank account, which, I mean, again, probably you and I like. It kind of makes us feel a little bit more confident, but how do they guarantee that? How are they going to do that, huh? Think about that for a second. How are they going to do that? It's not like they're just giving you like taxpayers' money. No, what they're going to do is they're going to print more fucking money and use that to backstop it. So it just creates a cycle of inflation there. Again, spending money you don't have. Central bank swap lines to supply dollars globally. Federal Reserve balance sheet expansion from 870 billion to 2.2 trillion within months. Again, that's fucking big, like 2.5x right there. The birth of quantitative easing, QE, which was central banks buying long-term bonds and mortgage securities with newly created money. Okay, let's say that statement one more time. The birth of quantitative easing. Here's what quantitative easing is. Central banks will buy government long-term bonds and mortgages, the mortgage securities with newly created money. So the central bank creates more money, then they use that money to go buy government bonds. Interesting. Anyways, interest rates were cut to zero, ZRRP. The European Central Bank and Bank of Japan followed as well. So again, this was a coordinated effort. Is why also the global economy is so fucking connected as well, especially amongst first world countries, or Western countries, I should say. The phrase "too big to fail" entered policy orthodoxy. Failure was no longer permitted. And again, I mean, like, imagine what if these banks did truly fail? It would have been really bad as well. I'm not sure what the right answer. I mean, maybe they should have failed, and then we should have dealt with the issues, and then maybe with some miraculous change of heart, maybe just fucking maybe we wouldn't overspend ourselves in the future, and maybe we'd learn a lesson. That would be the ideal picture. But would we actually do that? History does not support that. We don't really learn a lesson. Anyways. The reset transformed the global system into a permanent liquidity support regime, a world where markets survive only because central banks underwrite them. The new normal, endless debt expansion, suppressed yields, and central banks as the de facto buyers of last resort for sovereign and corporate risk alike. Anyways, the impact on the everyday person was this. Mass unemployment, 8.8 million US jobs lost. Global unemployment rose by tens of millions. Which is always a good, thing, right? People just not having jobs, it's always going to cause issues outside of just not having jobs. Foreclosures, I should say. Over 10 million American families lost homes. Entire neighborhoods in Detroit, Las Vegas, and Florida were wiped out, amongst others. Retirement destruction. The S&P 500 fell 57% from its 2007 peak. 401ks and pensions evaporated. And again, let me just show you the chart here. This was this. S&P was trading at about 15 to 1600 in 2007 in October, and by the bottom in March of 2009, it was trading at a low of literally triple sixes. Anyways, savers punished. Ho! You don't say. Savers punished again. Interest income collapsed to near zero. Real returns negative for more than a decade. The wealth transferred upwards. Why? Because the wealthy typically are the ones who actually own assets. And so asset prices recovered rapidly due to QE, benefiting those with financial assets. Wage earners stagnated. Again, if you own assets, you benefit from these things. If you do not own assets, or if you save in dollars, you get fucked from these situations. Always remember that. And in today's world, there's actually, in my opinion, very little of an excuse not to prioritize the buying of assets. Almost everyone can at least afford to buy some amount. And if you can't, reduce your expenses until you can. You are probably living above your means. I understand that this might be a very inflationary statement, a very inflammatory statement. And there certainly are situations where that is not true and people really are stuck. But if you aren't stuck, you have no excuse. You need to buy assets if you want to have a chance. And if you do buy assets, things actually look pretty fucking good for you, which is why I think it's such a travesty that we do not have real financial education in the Western world, because if more people understood the system, more people would benefit, and it wouldn't even reduce the amazing results that that typically the wealthy, or just I should say asset holders, enjoy. It would make the pie bigger for everyone, in my opinion. And it's not even necessarily the wealthy. What it is, it's owners versus renters. Owners versus renters. You want to be an owner. You want to own things. You don't want to rent things. You don't want to finance things. You want to own things. You want to be a landlord. I mean, you want to be like a medieval fucking feudal lord. That's really what it's all about. The system really hasn't changed that much in terms of what actually is prioritized. That is the real wealth to begin with. That is the real asset. That's what actually has value. Everything else is just a vehicle to hopefully acquire more of that. Anyways, social consequence, anger and distrust of financial elites surged. Occupy Wall Street was a thing. Tea Party, Eurozone populism. Yeah, all of these were pretty nasty during that time. I do remember that for sure. The underlying message was risk was privatized in the boom and socialized in the bust. So yeah, I totally understand, I totally understand people being pissed off at this, at the system. I get it. I fucking get it. Anyways, households learned that governments would print to save banks, but not citizens. Anyways, the Bitcoin parallel here. Again, the genesis purpose of Bitcoin. So in case you didn't know, when Bitcoin was launched in January of 2009, there was a message that was embedded in the first block. This is crazy actually to know. I don't think many people know this, honestly, but in the first block that was created for Bitcoin, there was a message that was embedded that said the chancellor on brink of second bailout for banks. Chancellor on brink of second bailout for banks was literally the message. So the chancellor was on the brink of a second bailout for banks. It's basically telling you, hey, here is why Bitcoin is being created, to get out of that system and not have to deal with really the consequences that other people are, imposing on the everyday person. Again, hard-coded scarcity. You already know this. No bailouts, no counterparty risk. Self-custody, neutral settlement, and opt-out mechanism. During fiat crisis or hyper financialization, Bitcoin provides an alternative monetary rail not subject to political discretion. All right, we have three more. I know this video is very, very long, but hey, this is for the financial nerds out there. Anyways, 2020, pandemic liquidity crisis and fiscal monetary fusion. And I assume everyone who's watching this absolutely remembers this. This was the Rona times in 2020. Anyways, the lead up to the 2020 pandemic, the world entered 2020 with record global debt, over 255 trillion, so more than 320% of global GDP. A decade of near zero interest rates after 2008 created an everything bubble. Stocks, bonds, and real estate all trading at record valuations. Corporations were heavily leveraged via cheap buyback debt. Governments ran a structural deficit, and households depended on continuous credit. When COVID-19 hit, global economic activity collapsed within weeks. Travel, retail, and manufacturing froze. Revenues for small businesses fell 70 to 100% in some cases, just wiped out. Investors rushed into cash and treasuries, dumping everything else. But by mid-March of 2020, the entire financial plumbing system locked up. Treasury markets, the deepest in the world, became illiquid. The U.S. commercial paper market froze. Credit spreads exploded. Even investment-grade issuers lost access to funding. The world faced the first simultaneous supply and demand shock in modern history, threatening total monetary seizure. Again, what exactly was this? It doesn't really look like that much on this chart, to be honest, right here. It was this saga right here in March of 2020, basically. But it was a very intense, couple months. Things were down 37.5% from high to low in SPX. In Bitcoin, significantly bigger drop down, actually. This was this sort of segment right here, about 60.5% from high to low. Not great. But yeah. Anyways, the reset. So the solution to this situation was this. Central banks and governments responded with speed and scale never seen before. The fusion of monetary and fiscal policy. Oh, shit. Federal Reserve actions. Cut interest rates to zero. Expand balance sheet by $3 trillion in 90 days. That needs context, though. Because prior to this, the balance sheet for the Fed was $4 trillion. So expanding it by $3 trillion was almost fucking doubling it in 90 days. It's like people wonder why we have so much inflation now. It's because of this, or amongst other things, but because of this. Things are basically 2x more in terms of their cost at this moment because your purchasing power is just halved. And of course, the Federal Reserve also launched dozens of facilities, buying corporate bonds, ETFs, commercial paper, municipal debt, and even providing direct loans to companies via the Treasury. It's just insane, man. Like the fusion. I mean, it's almost like Well, no, I won't go there. Anyways, and then they introduced unlimited QE, or QE to infinity, with no upper limit to asset purchases. So basically, the Fed was buying fucking assets. Crazy, man. Totally crazy. I mean, this is socialism. I mean, it's crazy to me that the U.S. did this. You know, we've lost our soul as a country in doing this. And we might even lose our world reserve currency as well. In fact, we probably will, honestly. I mean, at some point, it's inevitable, to be fair. Anyways, the U.S. response was this. The CARES Act gave 2.2 trillion in direct stimulus checks. Those were the stimmy checks to citizens and forgivable PPP loans to businesses, which were also massively fraudulent for many people as well. For the first time, the Treasury and the Fed acted as one, blurring the line between money creation and fiscal spending. Yeah, not good. Central planning, not fucking good generally. Globally, other central banks followed. ECB's PEPP, BOJ's, which is the Bank of Japan's expanded ETF program, and massive liquidity lines for the PBOC, that's China. The world had entered the age of permanent monetized deficits, a fiscal monetary merger that effectively rewired how money is created. The impact on people was this. Immediate relief. It was actually good immediately. I mean, stimulus checks and forbearance programs prevented mass insolvency. Personal incomes actually rose in 2020 despite the recession. And I recall that time as well. You know, that time from 2020 to 2021, people, you know, generally people felt pretty good financially, actually. You know, a lot of buying going on. Assets boomed, as we already know. Central bank liquidity drove stocks, crypto, and housing to record highs, even as 20% of workers were unemployed. Not fucking good. Inflation lagged, but it did surge. By mid-2021, the delayed effects hit. U.S. CPI reached 9.1%, the highest since 1981, which we went over as well. Everyday essentials like gas, rent, food rose 30 to 100%. 30 to 100%, basically doubled in some cases. And certainly by now it's probably doubled in many cases. Wealth gap widened. Those with assets saw massive windfalls. Renters and savers saw their purchasing power collapse. Again, savers, renters, people who don't own shit, you get fucked. The only way to not get fucked is to own. So don't buy your fucking, you know, Gucci sweatshirt or whatever. Buy fucking Gucci stock, if anything. Moral hazard entrenched. Markets learned that any crisis would trigger instant money creation. Risk perception died. The pandemic response transformed capitalism into permanent stimulus economics, the expectation that the state will print to cover every shock. And the Bitcoin parallel here, again, hard capped issuance. You already know this. Self-sovereign access. You already know this. Inflation hedge. Yes, you know this as well. Borderless lifeline. Citizens in countries that printed excessively or imposed capital controls like Argentina, Turkey, and Lebanon during these times used Bitcoin as parallel rails for remittances and savings, and then transparency. And I just want to show you, Bitcoin did get fucked during the actual 2020 event right here. Again, down about 60%. But from there, it had significantly better returns from low to high over the next couple of years compared to traditional markets, going up more than 1,500%. And, you know, if we fast forward another few years from there, even more so. So Bitcoin did do quite well during this time. It's an asset. Anyways, 2022 reserve seizure and sanctions shock. All right, so this one's a lot more recent. Lead up to 2022 reserve seizure. So this is basically going to be coming off of the back of Russia-Ukraine situation. Geopolitical break. Russia's full-scale invasion of Ukraine in February of 2022 forced the G7 and EU to reach for non-kinetic leverage. Basically, we didn't want to go to war, but we wanted to impose, costs on Russia. Dollar systems concentration meant that global payments, funding, and reserves run through USD rails. So correspondent banks and SWIFT and offshore, these sort of things, dollar markets. Central bank reserves are mostly claims on Western institutions like treasuries, euro assets, bank deposits, inside money, in other words. And energy entanglement. Europe's dependency on Russians' gas and oil meant sanctions had to target finance first, not immediately full energy embargo. So here was the reset. The central bank reserve freeze. Roughly 300 billion of the Central Bank of Russia foreign exchange reserves at Western custodians were immobilized. This was unprecedented for a G20 central bank. I just want to highlight this for a moment. and also Russian banks were ejected from SWIFT, which basically blocked them off from our system. Now, when you're the reserve currency of the world, one of the biggest things is just other people trust you. They trust you that when they store their money, when they store their wealth with you, that they can access it, that they can get it. And what happened here is that the U.S. basically cut Russia off, which sent a signal to all other nations in the world, especially America's enemies, that, hey, yeah, we want you to invest in us and we want you to buy our bonds, basically. But if push comes to shove and if you don't do something that we don't fucking like, we will cut you off. Again, I don't know if that was the right call. Because what else are you going to do in this situation? The other solution is just war, I guess, but like actual war, like entering the war. But at the same time, you basically just nuked your own capabilities to be the world reserve currency, because who's going to trust you after that? You can't. Anyways, payments and banking bans. Key Russian banks were ejected from SWIFT, as we just said. Yes, okay. Corresponding USD and Euro settlements were blocked for sanctioned entities like Russia. Visa, MasterCard operations inside Russia ceased for cross-border use. Secondary plumbing moves, expanded export controls, asset freezes for oligarchs, shipping insurance restrictions for energy flows, Russian countermeasures. They did emergency capital controls, mandates to convert exporter foreign exchange earnings, temporary foreign exchange withdrawal limits, key rates hiked to 20%, creation of Type C accounts to trap non-resident holdings, domestic card rerouting, etc. And the systemic implication here is it proved reserves are political IOUs, not neutral assets. The U.S. is not neutral. If you don't follow what we want, we will fuck you. And so your money that you're holding with the U.S. is not really yours. It's an IOU. And so again, it's like, I don't know if that was, I can probably argue both sides, but I can tell you if the goal is to remain the world reserve currency, that was the wrong call. But then again, do you really want to be the world reserve currency? I mean, there's a lot of pros to it. There's also a lot of cons as well. But yeah, again, I'm not making a call here. I don't fucking know. I'm just some dummy on the internet. Anyways, here was the impact on the everyday person. In Russia, the immediate reaction was the ruble whiplash. There was a sharp sell-off. Capital controls, rate hikes, snapback, volatility, crushed household purchasing power. Basically, people were fucked, as usual. Banking frictions, long ATM lines, foreign exchange withdrawals capped, cross-border cards failed, imports, electronics, meds, parts, scarce or pricier via gray routes. Inflation shock, CPI spiked, real wages fell, SMEs dependent on imported inputs suffered margin collapses. Of course, state savings were trapped. Non-resident investors and many locals found assets immobilized or only tradable in restricted venues. Dividend coupon flows blocked or rerouted. I mean, like, just a total collapse, man. It's crazy. Outside of Russia, so the second order of effects was the energy and food spike in Europe, especially. Gas and electricity soared. Fertilizer and grain routes disrupted because we were getting a lot of that from Ukraine and Russia. And global food inflation. And again, this was coming after, the 2020 pandemic as well. Portfolio and trade plumbing, multinationals wrote down Russian assets. Euro corporates scrambled for non-USD settlement workarounds, and longer-term de-dollarization drive, again, at the margin. Like, this is what I'm talking about. What are you going to do if you're an adversary to the U.S.? What are you going to do? Well, you're going to start to de-dollarize. Or maybe even if you are a friend to the U.S., you might de-dollarize just in case. More Chinese yuan settled trades began. Not fucking good, especially as America's, main adversary. Bilateral netting, gold accumulation by EM, CBs, and accelerated CBDC and M bridge pilots, basically central bank digital currencies. And risk repricing. So sovereigns reevaluated custody risk of reserves, meaning why would we hold our shit in America or Europe if they're just going to confiscate it if we do something that they don't like. Commodity exporters push for friendly custody or outside money, gold in this case. Again, here's your Bitcoin parallel. I mean, this one should be glaringly obvious, but you got censorship-resistant settlements. So, if you want to hold your wealth, are you going to hold your wealth in America if you're Russia, or are you going to hold it in Bitcoin if you have both these choices? I mean, I think I think it's a very logical thing in this case. Self-custody Bitcoin lets ordinary people send or receive value without correspondent banks or card networks. When SWIFT, which is the Western money processor, or Rails basically, cards fail, on-chain transfers still clear globally 24/7. It works even more than SWIFT, to be fair, 24/7, 365. Portability under capital controls. Again, So imagine you're some Russian oligarch who has all of your wealth in a fucking, yacht that's kept in Europe or anchored in Europe, and they confiscate it. Well, that's gone. But if it's in Bitcoin, well, they're not gonna be able to do that as well. Outside money reserved for households, and of course, real world caveats for this situation, but they are important. On and off ramp friction. Exchanges can be sanctioned. You need peer-to-peer and non-custodial know-how ahead of time. So it's like Bitcoin it's not perfect, but I think it's a better alternative than most things. Operational security, you have to protect your keys, obviously, understand chain analytics and visibility, consider privacy tools where legal, of course. And regulatory risk, using Bitcoin against sanctions may be illegal. Ordinary savers using it for basic resilience should stay compliant and pre-plan lawful routes, of course. Anyways, here's the common pattern that we just went over. And by the way, we're about to get into what I think is going to happen next. But anyways, common pattern is this: confidence breaks, markets no longer trust the existing reserve or exchange structure, then liquidity freezes, credit channels seize, central banks lose control of the transmission mechanism, policy overreach, emergency measures violate prior monetary norms like confiscation, devaluation, QE, capital controls would all be examples of this, and then re-anchoring. A new set of rules, reserves, and institutions emerge. What was safe yesterday no longer is. What typically happens is savers get fucked. If you take one thing away from this, savers get fucked. The impact on ordinary people: currency devaluation, inflation, real wages and savings collapse. Again, savers get fucked. Deposit freezes or capital controls, loss of liquidity and freedom to transact. Savers get fucked. Asset price and repricing occurs. Pensions, bonds, or housing values whipsawed. And inequality expansion. Those nearest to the new liquidity source recover first. Savers lag behind. Again, savers get fucked. Anyways, why Bitcoin fits in this conversation? You already know all of this, but Bitcoin is the first non-state monetary network that operates outside of central bank counterparty risk, is globally liquid and portable, enforces a fixed issuance schedule, and settles peer-to-peer without reliance on the traditional banking stack. So in a world of repeated resets, Bitcoin represents a parallel settlement layer, a lifeboat asset in times when the traditional system is being rewritten. So what's next? So here we come to perhaps the best part of this one. This is what I believe is most likely to happen next. This is what I believe the plan is, and this is what I believe the next reset is going to be about. And if you made it this far, I hope that this really does serve you well. I really strongly believe that this will happen. Again, there's no certainties in this game, but I do think that this is very high probability. I think this is the plan, and I don't know if this plan is going to work. I just think it is the plan. Anyways. This would be called the 2025 Quiet Financial Reset, the US dollar's digital conquest through stablecoins and the new monetary plumbing. All right, so let's talk about the lead up. After the COVID era QE binge, the quantitative easing binge, the global system was drowning in 30 plus trillion of US public debt and an increasingly fragmented financial order. Simultaneously, US dollar stablecoins like USDT, USDC, and others exploded from $5 billion in 2019 to over $150 billion by 2024. Over 70% of global crypto volume now trades in dollar stablecoins. Think about that. Again, global, effectively extending the US monetary reach into non-bank global digital rails. This is a really good way for the US to remain the world reserve power, or the world currency power, the world reserve power in a way. And meanwhile, de-dollarization efforts from China, from Russia, and the BRICS nations in general aimed to build alternatives. Yet the digital dollar quietly became the fastest growing reserve instrument in emerging markets. So while Russia and China are trying to do BRICS in their own currency backed by gold, the US realized, oh shit, we can just export our fucking dollars, make it super easy for anyone to use by digitizing it through USDT and USDC, and letting that flood out into the world. And that's going to be backed by what? What is it going to be backed by? Well, we just put in legislation in the US that it has to be backed by dollars. Anyways, the traditional banking system, overregulated and underyielding, began losing both liquidity and relevance to these faster programmable, always-on dollar proxies. Again, if you're some random dude living in Africa, a stablecoin sounds pretty fucking good to you. It works all the time. It's pegged to the dollar, and it's generally stable for your purposes, at least compared to what you got access to. Pretty fucking good alternative, to be honest. Anyways, the US Treasury and Federal Reserve took note, realizing they could digitize the dollar's global dominance without launching a risky full CBDC. So the government doesn't need to launch a CBDC. They can let the private sector do it. This is a super interesting revelation, in my opinion. We're going to see what the private sector can do in this regard. Now, we did kind of see that in 1907, to be fair. This, however, will be forced to be backed by dollars. I believe 1-to-1 is what policy has stated. So I think this actually might work. It's a fucking risk. It's a Hail Mary pass from the US. And if you don't know what a Hail Mary pass is, it's in football when you're like down at the very last, few seconds of the game and you throw the ball up super far into the air. It's super low probability, but it's your only chance to win. Anyways, here is the reset, the solution that's, in my opinion, in motion right now. I think that this is happening right now. Okay, policy trajectory. Rather than directly issuing a Federal Reserve CBDC, like what the euro is doing or what China's already done with the digital yuan, the U.S. appears to be privatizing digital dollar issuance via regulated stablecoins, effectively a public-private hybrid monetary system. This is interesting, in my opinion. Draft bills in Congress from 2023 to 2024 propose stablecoin issuer charters, 100% reserve requirements, and Fed oversight, formalizing these coins as narrow banks. So your USDT and USDC is going to be forced in the US to have 100% reserve requirements and Fed oversights. That's interesting. This would make Circle, which does USDC, or PayPal USDC, or even USDT, and others the de facto digital arms of the US monetary base, transmitting dollars globally through blockchain settlement. Oh shit. So the U.S. just found a bunch of buyers, a bunch of demand for its currency. And what can it do with that? Well, it can sell you more currency. Basically, it can export this currency and continue the system. Hopefully, at least for the U.S. If you're another country, maybe you don't want that to happen. Anyways, the underlying assets. So bank deposits lose their monopoly on money creation. Programmable blockchain native dollars become the new settlement layer. The treasury market remains the ultimate collateral, but distribution shifts from banks to code. The result, the US could re-centralize global financial control digitally while appearing to decentralize it. In a way, we are decentralizing it, but it is also under the US control in a way. Anyways, the impact on people. So I want to do pros and cons for this because I think that there are both. Pros, faster, cheaper global payments, instant settlement 24/7. That's quite nice. Access to digital dollars, even for the unbanked or in unstable economies. Again, you and I in Western countries can't fathom this, but if you're, from a second or third world country, this sounds great. Reduce friction for cross-border trade and remittances. Again, also going to reduce costs for a lot of these things as well. Anyways, the cons, systemic shifts. So privacy erosion, on-chain dollars are traceable naturally. Programmable money enables transaction level control. So there will be that. Financial censorship risk. Wallets or smart contracts can be geofenced, frozen, or blacklisted, which they have been as well, I believe. Bank disintermediation, which means stablecoin rails could siphon deposits from community banks into digital custodians, concentrating power even further. And dependency risk. Global savers move into USD tokens, deepening the world's reliance on US debt issuance and regulatory reach. Might be bad. The US hasn't really proven itself as great in that regard, or I should say responsible in that regard. So this isn't inflationary like past resets. It's architectural. Who controls the transaction layer, not just the money supply? So the US will control that. The US has in the past not had a good track record with, maintaining that over long periods of time. But it is something. So we'll see. Anyways, Bitcoin parallel here. Of course, Bitcoin is outside of that. It's outside of stablecoins. It's basically outside money. Stablecoins are inside money in digital form. Stablecoins still depend on U.S. institutions, treasury, and regulatory approval. So it's like the U.S. will still basically control it. Do you think that, if push came to shove, the U.S. isn't going to impose its will on these stablecoin issuers? Of course they are. We already know that. We have 100 years of history of this. Bitcoin remains the only digital bearer asset. The sovereign outside option of stablecoin rails becomes surveilled or politically restricted. The wise move, use stablecoins for liquidity, Bitcoin for sovereignty. Sovereignty means, it's yours. You get to control your own stuff, but stablecoins for just, immediate liquidity for your, usual daily expenses, basically. Stablecoins, in other words, are efficient transactional medium, convenient short-term store. Bitcoin, however, is self-custodied reserve asset immune to censorship or policy reset. Basically, hold your money in Bitcoin. When you need to access some liquidity, trade that for some USDT or USDC, and then use that for your immediate financial needs, while still keeping the rest of it in Bitcoin. And that is where we end our presentation. 1 hour and 42 minutes later. Holy shit. I apologize about how long this has been. I recognize that almost no one is going to stay for this amount of time, but I really wanted to get everything into this, because I think once you see all of the past iterations of these resets, this current situation becomes a lot more obvious. And while, look, I don't actually 100% know this is going to happen, it does seem to me like it is very, very likely. So I would say, yes, if I have to put my money on what's going to happen, this is going to at least be tried. I think it's already being tried. And the real question is it going to work? And if it does work, how long will it work for? Again, I don't know. But I do want to postulate this as the next financial reset. I think it's happening right now. That's what all the stablecoin acts, the Genius Act, the Clarity Act in the US are about, in my opinion. And it makes a lot of sense. I think the US, the people who run the US, are not stupid as many people make them out to be. They might be inefficient. They might be silly. They might be, out of touch. But I don't think that they're stupid. And I think that they do recognize this is an issue. The U.S. can't continue on its current trajectory, and it needs to try something new in order to retain its power if it wants to be the world #1 superpower. So that's what we'll end this presentation for today. Some things to think about. Again, I might be wrong about all of that, but at least I think it makes sense. And if you do see these sort of actions continuing to support this, then you can understand where that's coming from and the correct actions to go from there. At the end of the day, the one message of this is savers get fucked. And I'll leave you there. Take care. Much love. And I'll see you in the next one.